Well, as Naren joins us now, we will talk about fear, greed, small cap, mid cap, large cap, contra, valuations. But I must say, Naren is always smiling, and when he's always smiling, his investors are always very happy. They know that there is nothing to worry in the market. Naren, my friend, how you been? You said cat amongst the pigeon with your comments.
No, actually, over the last 18 months, we have been cautious. I would say continuously we've been talking of asset allocation. The problem is it has worked. And once it works, people talk about it. And you can look at all the interviews we've given over the last 18 months. We've been saying the same thing that you have to focus on asset allocation. Even the interviews around Diwali, we've been talking that people think that equity is equal to FD, which is not true. So I don't know what this debate is on. Unfortunately, the markets don't listen to any individual or anything. So I don't understand this.
Can I say that at least in your view, the way you look at markets and the way you look at valuations and future returns are always connected, you feel that in this current environment for next 3 to 5 years, small and mid cap stocks, given where they are unlikely to give market beating returns?
So like when we introspected over the last 3 months, what we realized was there were two problems. One was a valuation problem, which has been there for the last 12 to 18 months. We have spoken about it and it never worked. And there's a second problem in the form of flows, in the form of IPOs and various fundraising done by various people. So lot of people have bought from investors who are more knowledgeable than the buyers. And that is the second problem that we have seen. That is the second problem is what worries us actually, that investors have to be very careful. And the reason now, see, in our opinion, mutual fund sahi hai is the right thing. Is if you invest in the wrong product, the risk belongs to the investor, not to the provider. That's what we were trying to say.
Small and mid cap stocks, when you buy them as a category, they have a different level of risk. So while you may think that you're starting an SIP, define the SIP where you are starting, and that is something which you should be aware of. So it is a public messaging in terms of what is right and what is wrong. SIP सही है मगर कौन सी SIP वो ज़्यादा जरूरी है. Am I perfectly summarizing your thoughts here, Naren?
Absolutely, absolutely. That is exactly the point, actually.
So Naren, if someone has, let's say, it is the general view is, and I'm not making this as a small and a mid cap or a large cap special, but someone says that, look, small companies become mid cap companies and mid cap become large cap companies. If India is growing, small companies will become big. So what is wrong in it? Because ultimately, जो छोटा है बड़ा होता है, बड़ा और बड़ा होता है. That is the whole spirit of growth, right?
Absolutely. There is no doubt about the fact that a 20-year SIP in small cap or a 20-year SIP in small cap will beat a 20-year SIP in mega cap. But how many people are 20-year SIP investors? That is the challenge of what I have seen in the markets, and that is the biggest challenge at this point of time. And I was surprised. Last week I had a talk in a FIFA IFA event. So they presented me a book written by Devina Mehra. I opened the first chapter. It says asset allocation is more important than stock picking. I was so happy to see that, and that is the reality. Everyone is obsessed about stock picking, but asset allocation is what determines everything. And people have just ignored debt in the last 5 years. If you go and tell anyone that debt is an asset class and my CIO debt is never called on by any channel to talk on debt, that is a reality. But so asset allocation is more important than stock picking. How to convey it to people? And that is the reality. And luckily, I would say, 2 years back, my CIO debt helped me in saying that we have to push multi-asset, which had gold in it. If that was not done, I would have said that it was one of the best investment decisions that happened. And it was because of both of us that we actually realized that gold is a very good asset class. So I believe, the amount of effort that people spend in asset allocation in this country is much lower than what they spend in stock picking. In stock selling, I don't know whether they spend. They spend in stock picking.
What is the right allocation in this kind of a market where valuations exactly are not attractive, but the long-term growth prospect is still very strong? I mean, what should be a right allocation for next 3 years, 5 years, and 5 years beyond?
Is very tough at this point of time. The hunt for an undervalued asset class is too tough at this point of time. That is why in many of the events, I feel that bank FD and debt mutual funds look to be the most undervalued because they are the ones which have done very badly in the last 5 years. Normally when I look at it, and I would say office yields are the third, which look very attractive. So, normally when you do asset allocation, you have to identify the worst performing asset class on 5 years. So, on that basis, we've been recommending bank FD, debt mutual funds, and office because office yields are better than residential yields. So these are the three areas which look the best at this point of time. Office yields because because of this work from home, which was possible in many areas, and going away, that was an area which underperformed. So these are the three areas which look interesting, and that is the framework. But otherwise, it depends on your risk appetite, etc.
What should one do who says that, look, I'm here for 5 years? Should they expect low returns, no returns in small and mid cap schemes now?
I'm not going to answer that question. I put my foot in the mouth once. Putting my foot again and again in the mouth is not what ICICI would do to any investors. I think, see, the reality is, the asset classes which have done the best is obviously small cap equities. And the asset class which has done the worst would be liquid funds. So obviously, in my framework and ICICI's framework, choose the things which have done badly. That which would be mega cap in equity at this point of time, banks within sectors at this point of time.
You said debt is looking good, but why is debt looking good when dollar is weak? Why is debt looking good when global uncertainties are there? Why is debt looking good where in general that the macro environment is challenging?
See, you have to remember that cash has a value. When see, normally I'll tell you this is something my colleague Manish, the debt CIO, and me keep discussing. Normally, when everything is overvalued, you normally put money in gold. And what happens is, but this time, gold is even gold has gone up faster than every other asset class. So you can't put money in gold. So where do you put money? You have to put money in debt. So the reality is, in fact, last week, we are subscribers to Gavekal, and Gavekal has said that there are three asset classes which seem to be going together, which is all the FANG stocks, dollar, and gold. So he's saying that these three can go down together. So it's very interesting. Normally, in a framework of asset allocation, when asset classes are costly, we would put money in gold. This time we have to put money in debt or cash. And in US, for example, one of the investors we all admire, he has the largest holding of treasury bills today. So taking a cue from him, you have to put money in debt at this point of time, not put money in gold because gold has gone up substantially. So you don't put money in an asset class which is at all-time high at this point of time and say that is asset allocation. So and that is your strategic asset allocation. You do strategic asset allocation in an asset class which is not done well, like debt or fixed deposits. That is how we look at it.
I'm just going to hit the pause button. Naren, stay with us. I'm going to again summarize what Naren is saying, which is that, guys, what he's speaking is years and years of experience. And many may not know, I've known Naren for almost 25 years now, when he was on the other side, which is not on the buy side, but on the sell side. So he pretty much understands the whole nuances of the market in terms of what the compulsions of buy and the sell side. And this is experience. Naren has seen so many cycles. He's such a big practitioner of fear and greed that all he's trying to bring out is the fact that you buy something where there is stress. That's how you get a bargain. Investing is like gold, buying gold at the price of silver, not buying gold at the price of diamond. And a lot of small, mid caps, SME stocks right now, they're trading at price of diamond. Very few things are trading at the price of silver, and that is what I think Naren is again and again emphasizing, that guys, focus on that. And Naren, in last 3 years, I was reading a report that perhaps the amount of individual demat accounts which have opened, the amount of PMSs which have opened, the amount of individual households which are not directly managing money, it is a clear indication that there is little experience and there is a big participation. That's like herd mentality at play, Naren?
That is my biggest worry. If you look at some of the companies which don't make profits, those companies are able to do IPOs very easily these days. And I was an investment banker in 94, 93, 94. And in that cycle also the same thing happened. I was pretty young then. So, and in that same cycle, we used to see the same problem. So, it worries us a lot, and we are managing public money. So, it worries us a lot. So, I hope the investors who are new investors, what process they follow for investing. We keep telling people, you have to follow a process. Just like when you buy a car, you ask all the old owners of that car, are you happy with that car? Similar on a two-wheeler, are you following a process? Otherwise, if you go and invest in a loss-making company at absurd market caps, then you lose 50% and you have only yourself to blame. You can't blame the market. So this is the challenge of investing, which we keep worrying about. And having seen the 90s is something which is ingrained in us, and that's why we worry about risk much more than the recent investors. Because the 90s taught us risk. The losses that we all suffered from 94 to 98 is something ingrained in us. So when ICICI, the people in ICICI, the board tells us, look after the brand, all the time we go back to 90s and think about those risks. That is the reality. And that's why investors are much better investing in mutual funds if they are for at least one cycle. And in that cycle also, they should first start with hybrid funds and then in the second cycle go into equity. That's how they would actually benefit.
Talk about something which you've been, flagging off, value. A year ago, there was a lot of value in PSUs. A year ago, there was a lot of value in power. A year ago, there was a lot of value in power utilities. Where is value in this market? I mean, specifically to equity markets now. And your expression is telling me value kahin nahi hai, kahin nahi hai. I can shake my hands, right?
It's tough to find value. It's tough to find deep value. So we have moved out of this deep value syndrome and looking at relative value. We find relative value in banks and feel very happy because relative value is there in banks. We know that after 4 years of very bad relative performance, there is some amount of at least capital protection in some of the staple names. And, we believe that in telecom, we can't lose big money. So, there's a lot of relative value. I don't think we are in a phase at this point of time where you have this concept of value which we had 4 years back. That's not the situation at this point of time. That is the reason we are recommending asset allocation. Otherwise, we'll recommend equity in a big way in this channel. It's such an opportunity lost if 20 minutes of time is lost and we are telling at the most do systematic investment plan in large cap funds or those kind of things. We have lost opportunity. So we have only relative value in equity at this point of time. But large caps are not in bubble territory or anything like that. I think with some more FI selling or some more correction, they'll become attractive. But they're not cheap at this point of time.
And I again want to go back to that point before I move into my last two questions, that folks, this whole interaction with Naren is about identifying the importance of asset allocation. And I've learned it the hard way, but I've learned it, that asset allocation makes 80% of your wealth. And that is something which is the biggest truism in the market. Just like we say compounding is the biggest miracle in the market, asset allocation is the biggest truism in the market. The idea of having this chat with Naren is to perhaps emphasize on the importance of where there is value in the market. And if you are investing money, and ICICI Prudential, AMC has a fiduciary responsibility here to manage public money, they need to be careful in order to protect your money. So Naren, they say that courses remain the same, horses they change. Nothing changes in a market. How do you see this market topping out? Because one day this cycle will end. One day things will end for this market. I mean, do we have any telltale signs which tell us that we are in this discomfort zone right now, Naren. We are not in the bubble zone. Markets go bust when we go to the bubble zone. Thankfully, we are not there yet. Do you think it could be a melt up before we peak out?
How do you know it was not topped out? I mean,
you're the expert.
When I look at some of the IPOs which happened in the last 6 months, it looks to me it's possible that the market has topped out for the last cycle because some of the loss-making companies could raise money too easily. So in our framework, it could have been the top, actually. That doesn't mean that India is not a structural story. It is not that India can't grow. It is not that Indian markets can't deliver returns in the next 10 years. But in each cycle, there is a top. That top could have been made. Doesn't mean that India won't deliver returns for the next 10 years. That is not the point I'm saying. But maybe for this cycle, the top may have been made.
Last question, and we've just changing topic, and I know we managed to squeeze you out from your morning meeting for this interview, so really appreciate that, and the fact that you came out and you are essentially on the front foot clarifying all the myths which got attached with your comments over the weekend. My last question is that everyone is of the view that there is trouble in the US economy. Everyone is of the view that this entire long dollar money moving back into US dollar trade is not going to continue. But the point is that trade is still elongating itself from last couple of years. When do you see this long dollar trade peaking out? And if it does peak out, what does that mean for India?
See, this when is a tough question. But I think the longer it goes, the bigger the fall. That is the worry. That what happens at that point of time is something we worry about again. And that is the reason we are very scared to tell people to take maximum risk now. We tell people to take lower risk. Because, clearly, if you forget India, India is not an overvalued market when you compare it with NASDAQ, for example. I think NASDAQ as a market is much more overvalued than India at this point of time. And the way dollar has been just going up and up and up, we don't understand what's happening at this point of time. So in fact, the environment globally is also so confusing at this point of time that you don't know what's happening. I mean, people expect that we should know exactly how this entire global market, particularly the US market, will unravel. Actually, we don't know because every day there are policy changes, which frankly, even all the global research houses are not able to predict and tell us. So I think these are challenges that are there. And that is the reason you can't take maximum risk today. You have to take only moderate risk today. And if people lose money, there's nothing we can do about it because at the end of the day, it is not a situation which is under our control. There are things which are controllable. There are things which are uncontrollable. What is controllable is don't take maximum risk today. That is all that is controllable. Can you control global policies? The answer is no. Every day you see different tariffs coming, and those tariffs sometimes get withdrawn in 24 hours. So these are things which are not in our control. Let's accept.
Fantastic point, Naren. What is in our control is perhaps risk, where we invest, and the time horizon. The returns, exactly. The global environment, the news, all of them are not in our hands. And certainly returns are not in our hand. So the point Naren is again trying to make is that don't get swayed by the recent performance and assume that the future returns would be that high. The risk reward ratio is to keep return expectations low, and the environment is sticky that maybe it's not time to bat on the front foot. But Naren, you batted on the front foot today, and you've given us enough and more time to really talk about your thoughts and what the hullabaloo is happening in the media about your comments. So thank you for that clarification. Thank you for joining us, and thank you for accommodating this interview request.
Thank you for the opportunity, Nikunj.